Welcome to Market Mondays at the new time of 9 a.m. GMT, 5 p.m. AEST. Danny, good to see you. How's your weekend?
Good morning. Good morning, Carl. Good morning, everyone. It's a good weekend. Back here, not as bright and early as before, but still bright and early to go through the markets and what to expect this week.
Yeah, I definitely benefited from the extra hours sleep this
Yeah.
morning. But again, welcome to Market Mondays, the weekly market webinar. I'm Kyle Rodda and Danny Hewson. Let's go through the risk warning very quickly. I'll start with the Australian version. That's to say the information you hear here is of general nature only and doesn't take into consideration anybody's personal circumstances. So make sure you consider your risk profile and risk appetite and whether CFDs are right for you before trading them. Danny, also something similar, throwing spread bets in there for extra, I don't know,
Caution.
complexity.
Yeah. Indeed. Yeah. So just again, as Kyle was saying, just this is general market information, not to be taken as trading advice. And also just be aware that the products that we do offer at Capital.com, which are leverage products, do carry a high level of risk. So make sure you are aware of these risks before trading them. That includes CFDs. And of course, for those of you in the UK, spread bets as well.
Yes, let's go through what we're going to basically be talking about this week. And realistically, we'll focus on the trade deadline, which may not be a trade deadline in the end. There's some sort of talk as to whether that will, actually be a sort of a hard or soft deadline, but we'll get to that in a second. But we'll also just cover off for good order the jobs data that we received last week, what that means for the markets going forward, especially monetary policy. And amidst all this, the run-up, generally speaking, that we're seeing in equities, but the outperformance that is specifically being seen on Wall Street compared to the rest of the world. But Danny, let's dive right in. July 9, trade deadline, but also in the last couple of days in particular, we're hearing rumors that perhaps there might be an extension provided to trading partners to maybe nut out these deals, which up until this point in time, there's only really been three, and I think for the most part, they're considered frameworks rather than deals sort of signed onto paper, if you will.
Yeah, indeed. It seems like, the US government is trying to, I guess, improve sentiment around it, given that we've seen the last 6 weeks or so where we've hardly had any news and any advancements, at least publicly, in these trade deals. Obviously, markets and general population have been focused elsewhere with everything that's been going on in the geopolitics world, which has kind of left the US, I guess, a bit of a grace period to kind of do these deals behind the scenes. But now, of course, the date is right in front of us. And we haven't really had, as you say, much information. And it seems like there are a few deals that are in the work. We saw President Trump saying that letters are going out today on Monday, and that he expects a lot of deals to be announced in the next few days. So it's just going to be interesting to see. I think markets are going to be very focused for now. It seems like positive sentiment is positive, but can things sour? Who knows, right?
Yeah, I mean, I think for me, the way that I'm framing it at the moment is that markets are pricing in a lot of good news, and it's based on maybe the discounting of three things. Either that a flurry of trade deals get done over the next couple of days, and this is the end of it. There's an extension, and maybe the taco trade kind of wins out again, and we get another, like you said, kind of extended grace period where deals can get done. Apparently, Japan, South Korea, and a few European countries are the sticking points at the moment. The last, parameter is some combination of the two, where we get some extensions for some trading partners, we get some deals done over the next couple of days with others. We had Vietnam obviously being the latest one. And the markets are kind of looking through this risk as being a Liberation 2.0, that it'll be a little bit of a fizzer. On the one hand, it means that I think if we get these trade deals coming through, investors are going to buy into that news. They're probably going to buy into the news of the pause as well, because it at least sort of flattens out the volatility curve, so to speak. But in saying that, if for whatever reason we do get the kind of shock that we did on Liberation Day, and it's sort of worth recalling that Liberation Day itself was being priced in to the date, and there was a fairly high bar for surprises being set, because the markets were more or less expecting a tariff rate that would average kind of around the low teens. It exceeded it significantly because of the Trump administration's obvious desire to try and nut out and iron out these kind of significant trade deficits with its trading partners, and the markets obviously did what they did. So there's a real asymmetric risk, I think, going into this event as a result.
Yeah, I think we've also had some commentary from Treasury, US Treasury Scott Bessent, kind of saying that he expects, or the US government expects a lot of deals to be made, but if they weren't to be made, they will be sending letters to some of these trading partners, notifying them that essentially what will happen is they'll revert to the April 2nd tariff level. So that's when you maybe start to see a little bit of risk in the market if that were the case. Of course, it's going to depend on who gets what kind of deal, right? As you were saying, it's not going to be a one for all scheme. It's going to be based on individual circumstances. And I think markets are focused on some key, very important trade deals. Of course, the more that are dashed out, the better. The more positive sentiment will be in markets. But I think even if we do get a few sticking points where potentially there's a little bit more friction and therefore higher tariffs are announced, I think if those key ones that are focusing on things like China, like the EU, like Canada, like Japan, Korea, if we do see some of these very important trading partners come out with a deal, I think sentiment will remain positive. Now, I think, and we'll look at charts, of course, and you can see just there as we're coming, just the offset of the key, some of these key charts here. You can see in general, sentiment has been very positive. The S&P 500, the NASDAQ 100, of course, reaching again those highs last week, the Dow Jones as well. But we have seen a little bit of lagging in European equities, like the DAX 40, like the FTSE 100 as well, and also Asian, like the Nikkei here. You can see struggling to post those new highs last week, even as the US was outperforming. So there is still a little bit, I guess, of reluctance in markets to really be a firm buyer elsewhere than the US right now, where this return, I wouldn't say return to exceptionalism, but there's been another kind of wave towards the US. And I think one of those key ones is going to be the European Union. We had reports from negotiators on the weekend, I believe it was on Friday, from diplomats in the EU saying that they had indeed failed to see any breakthrough in reaching an agreement with the EUS. They were going to try over the weekend. We haven't had any updated news from them, but the EU might actually be a sticking point. And I think right now, given the deadline is so close in 2 days' time, I don't think the hope now is for a deal. I think what they're hoping is for another extension to be able to negotiate further. So things like Europe is going to be, again, not so much about what's achieved within these 2 days or what has been achieved up until now, because we know that it's still an area where there's been a lot of struggle. But I think if we do get another extension, that would be a positive signal for markets.
Yeah, and I think it's really good anchoring this kind of conversation too, in the fact that if you take more or less the Liberation Day tariffs, and there is that big chart that obviously was propped up on the dais there by Trump that outlined all the tariff rates and the very strange way, well not strange, but sort of spurious way that they were calculated. If you take that tariff rate and you eventually see a deal that is significantly lower, maybe half of what we saw on Liberation Day, the markets are probably going to buy into that. And a good example was Vietnam. The average tariff rate, I think, is going to be around 20% or thereabouts. It might even be closer to 30%. Don't quote me on that. But the point is, it was significantly lower than the Liberation Day tariff rate that was announced. If that's the kind of deals that you get with trading partners that are half the tariff rate that was announced on Liberation Day, you're going to get markets kind of rallying into this. To your point too, Danny, and just I should say, if people have questions to ask throughout the webinar, please pop them into the question box and we can answer them as we go, just to keep things as interactive as possible. But I think it should be said that there is obviously more going on in the world than just, we'll go back to the trade thing in a second, but obviously the story for the United States is that there's more going on driving that market higher than just the trade tensions. And specifically, the reason why Wall Street is outperforming is effectively we've got this kind of resilient AI technology sort of trade going into earnings season, which is in the next couple of weeks, which is pushing Wall Street higher. And that's just an earnings story as well, which we'll cover off maybe in future episodes. But it sort of suggests that the reason why we haven't got European equities at current levels, at record levels like US equities, the reason why we haven't got the same for Asian equities, and the reason why we've got the Dow a little bit below record highs as well, and certainly the Russell and what have you, not at sort of April 2nd levels, is that the markets have priced in a growth hit for more cyclical indices. It's just that growth hit for the S&P 500 and NASDAQ has been offset by the strong, more secular story when it comes to earnings growth for the tech names, especially. And I'll say just one more thing on the tech thing is that there was that kind of somewhat paradoxical push close to record highs or a continued rally despite trade uncertainty, sort of re-inflamed in May or whatever it happened to be. And one reason why it wasn't spoken about very much was the really strong tech earnings that we got in April and May. Far exceeded those expectations from analysts. I think earnings per share was 20%, 27% versus 16%. What that means is, despite the fact that all of this trade noise, if you will dominate the narrative over the next few weeks, keep in mind some of the other factors that are driving markets too, especially on Wall Street with earnings season coming up, because it might seem that the markets are pushing through bad news when really they're rallying off other factors like company fundamentals.
Yeah, I think one of the key questions I get a lot of the time is, how can equities hold up so well, given that interest rates have been so high for so long? And I think here, as you were saying, one of the key factors and what's making the US stand out right now is that growth factor coming into the equation. Because in theory, higher interest rates do reduce the present value of future cash flow. So essentially meaning that what future earnings are worth now are diminished, right? But if you put growth into the equation, therefore growth remains strong, then corporate earnings are expected to continue to rise, therefore they offset this rate pressure. So that is what's been driving this resurgence in US equities, and that's why they've been outperforming Europe. And a lot of this coming, of course, as we said, from that US jobs data that we saw last week, coming in stronger than expected, once again showing that resilience in the US economy. And something as well to keep an eye out is you can be bullish on equities, bullish in stocks, and still be, for example, underweight long treasuries. And again, it goes off to play with that growth factor. So even if you think that equities will continue rising, even if you think that the S&P 500, the Nasdaq is expected to continue to go higher because of that resilient growth, you can also expect long-term yields to continue rising, and therefore you can be bearish on longer term treasuries. So there is this growth factor that comes into a lot of these equations that is kind of skewing what people would expect would happen right now. And that's where we're seeing that resurgence in US equities. Of course, we did see that shift away from US exceptionalism over the last 2 months as markets feared the impact that tariffs would have on US growth. But given what we've seen up until now, where in fact tariffs have not come into play to the extent that we were fearing, and growth has remained resilient, that fear has started to be priced out, and that's where US equities are now outperforming, and we're likely to see this scenario continue if we do see this rhetoric continue to play out, where the US economy remains strong and the fears of tariffs have diminished. Now, one thing to keep an eye out, of course, is the spending and the US spending, and therefore the debt burden. We saw the big, beautiful bill being passed last week. Markets so far seeing that as, I guess, not the biggest threat right now. It is expected to boost growth in the US economy, but something that markets might watch out for, not right now, of course, but in the next 6 months, let's say, for example, is how that could affect the US debt structure, and how that could affect sentiment in US assets. For now, I don't think that's a concern, and that has been positive for markets. But yes, the US is expected to outperform. As I said, we can see it on the charts, in the equity charts, but it is something to watch out for, I guess, if you do want to be a little bit skeptical on the continuation of this outperformance in US equities, potentially looking at that debt structure and how that could be impacted by the big, beautiful bill.
Yeah, so we've got a few questions here that we might as well jump to as well. First one is more about portfolio management. Obviously, we can't provide advice, and generally speaking, we don't sort of speak too much about how to structure portfolios. But the question is effectively, is it a good idea to cash out portfolio a bit? I mean, I think it really does depend, generally speaking, as a sort of a principle, how you're allocated to begin with. But there's this kind of notion now whether with stocks at these kind of levels, whether the risk reward is skewed to the downside. And the problem is that I think that you've got to look at multiples where they are, and what is driving markets at the moment as far as the outperformance. And the thing is that if you are heavily allocated to some of these tech names, there is that concentration risk that clearly everyone's in the trade. But if the profits remain really, really strong, and again, you can't understate how strong these earnings have been for some of these tech companies to push Wall Street higher. Again, to go back to the last quarter, the earnings came in at about 28% for a year over year. The expectation was for 16%. They exceeded guidance. They expressed that they were monetizing some of these artificial intelligence investments, which has been a concern for ages. And not only that, they also said that they would increase CapEx spending on further artificial intelligence investments while also returning cash to shareholders through buybacks and, to a lesser extent, dividends and what have you. So, I mean, it's very natural to feel a little bit cautious when you've got stocks at record highs and with all these kind of risks ahead. But if you've got a sort of a bottom-up perspective, a heavy allocation to equities, but they're continuing to exceed on earnings estimates, and in fact, price multiples are lower than where they were at the start of the year. Assuming that you're not too overweight equities at the moment, I don't think you want to be necessarily rushing to safeguard your portfolio by going, completely into cash, because there is that risk that you're going to miss out a little bit. Again, it depends on as a general principle, it depends on where your portfolio sort of sits going into this kind of event. If you are very heavily overweight equities already, and you've already seen a strong equity outperformance in your equity share of your portfolio, then it kind of makes sense to maybe rebalance a little bit. But just by virtue of the fundamentals, I don't think there's necessarily that argument if you're sort of heavily allocated to equities more broadly, and a lot of that exposure comes from tech. But Danny, maybe another question here we've got on the US dollar, which I'll make a very quick comment about, because the question is, a weakening dollar, will it make stocks cheap and therefore a rotation into US stocks? I should try and share around some research that I found recently, but one of the really interesting factors about the weakening dollar after Liberation Day was actually likely due to a reduced exposure to US equities because of this concentration risk, and that a lot of the reason why the US dollar was appreciating over the last couple of years was flow not going necessarily into safe haven assets, but going into some of these large growthy tech companies, that when the Liberation Day tariffs were imposed and there was that concern that maybe that earnings outlook was going to be diminished, also weakened the US dollar as well. So that sort of says that potentially a weaker US dollar a weaker US dollar was a manifestation of what was going on in the stock market, rather than being something that reflects an opportunity to go back into the US stock market. So there's almost a positive correlation there. But nevertheless, Danny, maybe we'll broaden it out.
Yeah.
The
Yeah, no, I was just going to
US,
say,
yeah.
you're good on that. I mean, yeah, from a kind of, if you look at exactly what that means, what a weaker dollar means for companies, right? And if you're looking, for example, at trade relationships, if you're looking at FX pairs and how, euro dollar cable, that kind of thing, then yes, a weaker dollar does technically make US assets cheaper for foreign investors. Also, if it's companies that have significant foreign revenue, so significant business outside of the US, and then convert that into dollars, a weaker dollar does make for a higher conversion into so you get more dollars essentially for the money you're converting. So all of that does kind of indicate that the weaker dollar could lead into stronger equities. But something to watch out for as well is, of course, the inflationary pressures of a weaker dollar, something that the US economy has been struggling and battling with, and something that has been limiting the Federal Reserve from cutting rates has been that persistent inflation. This weaker dollar does pose a risk for inflation, for US inflation, and therefore that is an issue that continues to preoccupy, I think, a lot of market participants. Even though we are currently in a wave of positive sentiment in US equities, it is something to watch out for. That inflationary pressure could have some downside impact on US stocks. Again, not something that would be immediate, but definitely something to consider. So from the offset, answering that question, yes, a weaker dollar could benefit US stocks. But again, there are a few things to watch out for. And of course, it will depend on the nature of each company and each stock.
Yeah, I'm going to try and find this article, which was really interesting, about dollar flows basically being driven more like by private investors rather than being driven by sort of safe haven demand into treasuries. But we can move on from that, I guess.
I think, Kyle, one thing that we can point out is, and a question that we get is, going back to that portfolio question you were talking about, of course, as you were saying, explaining very well there, your how much positioning you have in US equities. But one question that we get all the time is gold, right? What's happening with gold?
Yeah.
And something that maybe investors have been doing, let's say in the last 6 months, is moving some of their capital from riskier assets like US stocks, like tech stocks, which had been struggling a little bit at the beginning of the year. You can see here on the NASDAQ chart how from mid-Feb, roughly, when we saw that US term, that Trump term start in the US, we saw that very negative impact on US equities, specifically the tech sector, up until that tariff day there on April 2nd. We saw maybe a lot of people shift from US equities into gold. And a big question we have been having is, what's gold doing? Why is it struggling to move? Why does it have this negative connotation? And I think we've covered this several times, but I think it's always nice to touch up on each webinar that we do. Gold, from a fundamental backing, continues to have strong fundamentals. We've said this many times. Central banks buying gold, expected rates to come down at some point, and therefore helping gold as a non-yielding asset. Also, some sort of safe haven demand as well. But we have seen the appeal of gold come down in the last few weeks as safe haven assets haven't been performing that well, with risk improving in markets, with sentiment improving. So therefore, we're seeing that pressure on gold limiting the move higher, specifically below that 3,500 level, which is a very, I think, it's probably turned into a psychological level right now. We did see an attempt to move higher last week, at the beginning of last week, but that was, of course, capped there as we continue to see US equities move higher. The RSI continues to point to the downside, so potentially a little bit more room here for correction. For now, it remains firmly above 3,000. I think, again, that's another key psychological level. But if we do see a further dip below 3,300 and some consolidation below there, then that bearish pressure could continue in the short term. But nonetheless, going back to that portfolio question, we may have some investors considering, well, maybe should I move out away from the gold positions that I had, that I bought as US equities were dropping earlier this year, and now that the US is outperforming, maybe shifting a little bit of that gold positioning into US stocks. It is a valid point, but again, it goes back to diversification and just making sure that, of course, portfolios are well balanced, that they're not overexposed to one area, to one asset, to one specific group of equities, for example. Kyle, I don't know if you have anything else to add on gold.
Yeah, no, it's just keep an eye out for the structure of the trend there. I mean, we've been speaking about it a lot over the last few months about gold strength and all the tailwinds that is driving it higher. I mean, I think structurally it's very, very bullish in the long run. It'll continue to move higher, even despite the fact today, just as a bit of an aside, we've got the Trump administration threatening the BRICS countries for, obviously looking for alternative payment systems away from the kind of the dollar payment system, which in principle should try and, attract or motivate those looking to move away from the dollar as a means of payment, not so much as a store of value, but as a means of payment to stay there. Ironically enough, it probably pushes them further away from the dollar because of, the risk that they're exposed to sanctions and the US dollar's hegemony. But ultimately, I think the gold story is still a very positive one. We're going to see a bit of de-dollarization. If we do see lower surpluses being built by trade surplus countries, dollar surplus being built by trade surplus countries being recycled, those dollars being recycled back into treasuries and into other assets, which are mostly going to be, maybe a little bit of European assets, maybe Japanese assets, but in particular, I think things like gold, the Chinese is a great example, as it's sort of accumulated its gold reserves over the last few years. Is that the gold I think will ultimately continue to move higher over time. But in the short term, though, just look at that kind of structure of the uptrend. Still higher highs. Sorry, I should say still a series of higher lows, but we haven't made a higher high yet above sort of 3,400. And if we do start to see, for example, around, call it 3,200, maybe 3,250 at the moment, where there seems to be a little bit of support, which would indicate that maybe we're going to make a lower low in the short term. That would indicate that maybe the sellers are starting to take control of the price, and we could see a bigger dip before that kind of structural impetus pushes gold prices higher and back towards levels that challenge record highs. Ultimately, I still think it's a buy the dip situation in gold. But again, you've got to listen to the price action. And if we do see one of those key levels break down, and certainly if we don't see the 3,400 level being sort of closed above definitively, then you might suggest that you sort of either hold out on further long positions until we see signs of kind of a reversal in momentum to the upside, or you take a more sort of tactical bearish position on golds that maybe sort of looks for support at lower levels.
Yeah, I guess the question here could be buy the dip, but what dip, right?
Yeah,
That's
of course. There's always,
probably something that a lot of
the
people
dip can
ask.
always keep dipping.
Yeah, the dipping continues to dip, and therefore at some point. But yes, Kyle, I think we've gone through most of the fundamentals for this week, the macro view. In terms of just giving our viewers, some key points for this week, and what to look out for. It isn't a very busy economic calendar, I do have to say. Of course, that July 9th deadline is likely going to be dominating sentiment in markets. So I would say watch out for any headlines that come. Watch out as well for any posts from Trump on Truth Social, any of social media. We know he likes to boast about his successes and also criticize other people as well. So you may get a lot of information from there. I think it's going to be very much a case of just being reactive to headlines and developments as they happen. As we said, the risks are heavily skewed to the upside in terms of there's a lot of positivity priced in here, and markets are expecting a good outcome. But that, of course, could lead to some heavy disappointment if that weren't the case, even though the likelihood seems much smaller. Other than that, from the UK, we will have that GDP data on Friday. Not massively important, but we did see a negative growth in the month of April, minus 0.3%. So we have the May reading on Friday this week. That might be something to watch out for those of you looking at UK assets like the FTSE, like the pound. Other than that, Kyle, anything else you're watching out for?
Yeah, we've got the RBA and RBNZ just out in the Antipodes down there. So RBA is expected to cut interest rates. The last meeting saw quite a significant dovish pivot and a reassessment of the balance of risks, focusing much more on the growth side of or employment side of their mandate rather than the inflation price stability side of their mandate. More or less suggesting that, well, they've come very close to mission accomplished on inflation, which is pretty legitimate. The trim mean inflation figure down there, which is effectively the core number that you would see most other places, is back within the RBA's target band, which is 2 to 3%. And the last employment figure was kind of mixed at best, suggesting that they can afford to cut interest rates a little bit. It's pretty much fully priced in. In fact, I think there might even be a chance of a 50 basis point cut discounted, which is probably a little bit excessive. It's interesting because I would have thought they might have waited for the next CPI figure to come out in Australia, which is normally quarterly, the official numbers, to cut again. But once more, the balance of risks has shifted away from inflation now towards getting ahead of any potential growth slowdown, especially if US trade policy weakens the Australian economy, which is very, very sensitive to global demand. So keep an eye out for that. Should be an interesting one. A cut in and of itself, because it's priced in, and 25 basis points is fully priced in. I think it's, like I said, 28, 29 basis points fully discounted. A cut itself won't move the dial. Obviously, a 50 would, very unlikely. But if some dovish guidance comes through suggesting that maybe there's another 2 cuts on the table before the end of the year, that might be a factor that sort of supports Aussie equities and weakens the Aussie dollar as well. So just keep an eye out for that one, obviously, with my little Australian bias there for sort of coming through.
Well, I think that's it. We bang on 30 minutes there, so keeping it nice and short and sweet, I guess, to some extent. Thank you, everyone, for joining us today. We will be back next Monday, as always, taking you through the latest economic data, the latest news, and hopefully some more news on trade tariffs and what's happened. We'll all be keeping an eye out for that. Kyle, thank you, as always. Everyone, have a happy trading week.
Thanks, Danny.
Bye, guys.